Hi all, hope you can hear me fine. Welcome to another casual fireside chat. We have Deepak, Vashisht, and Anoop from CapitalMind here today. As most of you would know, Deepak co-founded CapitalMind, has 20 years of experience in stock markets, and is often a guest analyst on CNBC, TV 18, and ET now. Vashisht is Chief Operating Officer at CapitalMind. He also
Hey,
co-founded.
can you guys hear me?
Yeah, we can hear you.
Yeah, we can hear you.
Yeah, so as I was saying, Vashisht co-founded a political consulting startup as well, called Politicai, my bad. Um, and Anoop manages Capital Mind Premium and runs the Momentum portfolio in the PMS service that Capital Mind runs by the name of Capital Mind Wealth. So let's just go ahead and start. We are going to be starting off with a segment called Let's Get This Over With. In this, we give the team a few trending themes or commonly talked about subjects around which investors are split, and then you folks give your views or opinions on them, preferably in a line or two. So, essentially, a rapid fire around buzzwords in investment circles. So, are you guys ready?
I am sorry. I hope you can
Yeah,
hear me.
let's go. So, the first up, we have the current stock market conditions. Do you think the valuations are stretched or more left in the rally? Thing?
Valuations are stretched, but more is probably still left in the rally. Typically, valuations can get more stretched than you can imagine. So, I wouldn't say this is the end. Given where it is right now, I don't think anybody should just pour all their money in right now. It sounds like even if there is steam left, there will be corrections coming up ahead of us.
That sounds more than fair. Next up is closest to everyone's heart, ITC. So, do you feel it's a value trap, a value bat, or is it simply nothing to talk about the company?
Yeah, it's actually an optionality on how long India does not have extreme fines and penalties for tobacco related cancers. In the West, this has not proved to be a very good thing. There will be at some point a judgment that will come that will possibly cause ITC damages for the tobacco business, which is their 70-80% ROC earning business. And their FMCG and hotels plays haven't really tapped out. So it's a very interesting play, but I think not there's too much of a risk in the extremes of fines and penalties. So you got to take it like that. Stock isn't moving. Stock hasn't moved for a long time. Just would wait till we get more clarity. Hopefully, there's a demerger. If there's a demerger, there will not be any fear of ITC's tobacco business hurting its FMCG business by taking up the cash. So that's the one thing that you can look forward to, but otherwise not so excited.
Fair enough. The next one has been in the news recently, Adani Group companies. Do you think the narrative is dead for good, or is there more to come?
Much more to come. The group itself has seen stocks moving up quite dramatically on low float. Low float companies generally become newsworthy at some point. We've seen one set of news that's come recently, but I'm definite there will be more. It may not be as bad as a DHFL or a Videocon where there's a complete default and a write-off, but I'm sure there will be corrections to these prices. They're already planning to delist one, so there may be some other structures like this that also happen and mergers and acquisitions as well. So would wait for it. I don't think it's the end. A lot more to come.
Right, right. We move on to the next theme, which has investors across markets scratching their heads, not just in India, all around the world. Value investing, do you think it's dead or is the resurgence on the cards?
It's resurged, right? Last 6 months, I think from November onwards of 2020, we have seen value funds do really well in comparison with the Nifty itself. Perhaps after momentum, it's the best performing factor in the last 6 months. So I think there has been a resurgence. Typically, value stocks become more momentum oriented when markets hit their last leg of a move up. So you don't know how long that move is going to last, but it will take everything up with it. So I feel, yeah, it's not the end.
Fair, fair. So this is the last one we have for this segment. Technical analysis. Do you feel it's a good addition to an investor's toolkit, or is it something that you would advise most people to stay away from?
No, we've always been a big fan about prices giving us feedback. So I think technical analysis is largely the aspect of fundamental investing that is ignored by books and accounting and all that stuff, which is behavior. The concept of support, resistance, even moving averages, however it is, they tie down to behavior that people have. There's greed, there's fear, stocks hit certain troughs and go back in certain ways because these are largely linked to how investors behave when markets, stocks go up and stocks go down. If you link it to something like behavior, it gives you a very powerful arsenal in your toolkit, which is not just about how good the company is, but how good the company is perceived to be, both of which have a significant impact on returns. Which means you can buy a good company. If people don't see it as good, doesn't matter. Its good phase will go away, and you would not have realized the price out of it. If a company is perceived as good but is not really good, you can still make money on that stock. You've seen this in momentum portfolios. So technical, according to me, very important part of a person's stock analysis. This is me, of course, but there are lots of other people who would concur worldwide. It's only the pure value, very puritanical guys people who feel that prices are unimportant. I don't think that's true.
Deepak, are there money managers for that? Believe in that purity of value investing, or does everybody like a little tadka of momentum?
So there was this interesting conference. I think I had gone to Chennai for and then we had a side meet after that in the conference. And there were a bunch of people, famous PMS managers, and me, not quite that famous. So they were all asked about, what kind of what do you look at stocks when you look at stocks with value, growth? Some said value, some said growth, balance sheet, no risks. And I was like, listen, I like a little bit of momentum. In fact, if all the other factors check out and there's no momentum, I won't buy the stock. So, and then, closet, everybody else kind of said, listen, yeah, I mean, you need that factor. So you might not admit it, but I think momentum is what makes the world go around in the end. You don't have it, you're not going to make a lot of money from your stocks. So whether it's Warren Buffett or anybody else, I think it's we'll wink, wink, nod, nod, but we will not accept. But I don't mind. I'm shameless about it. I like it. So I like trends and momentum.
That's very interesting to hear, Deepak. Thank you for being candid with this. We have the segment over. So now Bag will take over for the next question.
Yeah, hi. So I had a few people asking me, they aren't really, they want the guests and speakers to introduce themselves once. I think we missed that in the beginning. So can we have a few lines about yourself, please? Starting with Deepak.
Okay. My name is Deepak. I'm an engineer by qualification. I did computer engineering and I ran a bunch of tech companies before I moved into algorithmic investing in 2007. Set up a company that would initially was supposed to provide data and strategies for algorithmic investing, and we eventually ended up running our own money on a fund which did reasonably well in 2008 when the markets were crashing, but unfortunately there was no way to raise money at the time after markets crashed. So my background is there. Started CapitalMind as a company in 2014 or so. Primarily now I write a lot about macro, about something about stocks, some about I used to write a lot about derivatives, don't write so much about it now. And in 2017, when we were doing all of the research at CapitalMind and telling people how to build their portfolio, some of them came to us and said, let's build, why don't you guys do it for us? Because this is all great, but there's a temperament, there's time, there's skill. Sometimes there is just not enough patience for people to do it on their own. So they said, why don't you do it for us? We started the PMS in 2017. And since then, we've grown reasonably. And I still try to do a little bit more about writing. I don't get enough of it, obviously, and also still researching more, and we've applied to be a mutual fund as well. So CapitalMind is pretty much wants to be a large financial intermediary in this space. So live in Bangalore, two kids. You might hear one of them in the background soon, but that's who I am.
A very warm welcome to Deepak. And can we have Calm Investor go up next?
Hi, my name is Anoop. Not a career investor by any stretch, unlike Deepak. I come from an engineering and MBA background, but most of my career up until recently was spent in management consulting. I used to work with companies on developing their 5-year growth plans and figuring out how they're going to cut costs and improve margins. Investing was always sort of a passion which I would follow on the side, and over the weekends started writing about investing on my site, thecalminvestor.com. That's how, in fact, I met Deepak, and we started figuring out how is it that we're going to work together. Started exploring quantitative strategies at some point in 2017, 16, which is where the whole philosophy of momentum sort of developed for me. And it looked like it could be a viable investing strategy over the long term. And here we are, writing about investing, managing some money using the momentum philosophy, and having some fun in the process.
Welcome, Anoop. And the third speaker we have today is Vashisht.
Hey, hi guys. I have the strangest background of the lot at CapitalMind. I studied at the National Institute of Fashion Technology in Gandhinagar. Then I went and spent 4 years in the world of policy making and politics. Started out as a legislative assistant to members of parliament, then ran campaigns in the 2014 election cycle. When you are much younger, you have a lot more idealism. I mean, you fly too close to the sun, or in this case, get the ugly look into how real politics works. The idealism in you dies very quickly. So around 2016, 15, 16 is when I got interested in markets. Although I was always interested in them, but I started spending more time actively on it. And that's when I met Deepak on Twitter. We exchanged some DMs on Twitter back then, and he flew me into one of our meetups. CapitalMind was very small then, I think 4 or 5 employees and about 100 people in our community. And we had a meetup in Bangalore. And then Deepak offered to fly me in, and I did, and that's when we met, and I joined him soon after in 2016. And since then, whatever Deepak said, we've been just working towards building all of these things. Started out as the PMS, we're growing our subscription and community business, and we've applied to become a mutual fund as well. Yeah. And in the whole process, hustling and doing these things, I picked up a lot of tech. So now I'm like 80% engineer and just a little bit of management here and there.
Nice. A very warm.
Bag, your mic bugged out.
It did?
Yeah, now it's fine.
Yeah. So a very warm welcome to everyone from CapitalMind. So today, the people here are a really big fan of your podcast, and we have before we jump onto the financial markets question, we have a question coming from Penelope on the Discord server. He asks, what gear and software do you use to record your podcasts and your live streams?
Oh, I can take that one. Very simple stuff. There is a very popular microphone called the Shure Beta 57, 58 or whatever. The standard vocal mic, not very expensive, or 5 or 6K. We use those, and we just record it into a Zoom recorder, and we use a software called Studio One to edit it and master it. We did pay very heavily for one software called Isotope, which is a Hollywood scale level noise, voice repair, sound repair software. So we use that when the sound quality is not great. We don't have great studios, by the way. We're just building one in our new office, but because of lockdowns, we haven't gotten too far with it. But even when you don't have much, I think software today is so great that you really don't need great hardware. There is an app called Dolby something, which you can install on your phone and gives you all of this cool stuff for pretty much free, which you can use your phone to record. Just put your phone inside maybe a closet, put a towel around you, and just record. You'll get as good quality as a studio. And anyway, if you listen to most very popular podcasts, they get billed by the amount of MBs they upload on the hosting servers. So they can tend to compress it to 64 bits or something. So they, regardless of how good the studio you recorded it in is, once you compress it so much, you lose most of the quality. So yeah, it's very straightforward these days.
Yeah. Thanks for the answer. I am sure everyone now knows what effort it takes to record a podcast episode. Next up, let's jump into the financial market question. So the first one is from a Reddit member, and it goes like, can non-Indian retail investors invest in the Indian market? Non-Indian retail investors invest in the Indian market. So they are asking these questions for their friends who are non-Indian investors living in other countries like the US and Dubai. And do they have any avenue to invest in the Indian markets?
This is a problem as far as I know, because I don't think individuals get to do the KYC the way the Indian regulations require it. So we don't allow non-Indian. So we allow people of Indian origin. So if you have a non-Indian passport, but your parents or your grandparents were in India or were Indian citizens, then I think you get to invest through the NRI route. But otherwise, you have to come in through a vehicle, and that vehicle can be a US mutual fund, a US hedge fund, an Indian hedge fund that is an AIF that is located offshore that can invest in India, and you have to use an investment vehicle essentially. So right now, individuals aren't given any permissions, similar to China. I think China only individuals can invest only through Hong Kong. So India, there are some companies which are listed as ADRs, like Infi as a US ADR, TCS, Wipro, a few other companies do, but those are listed in the US exchanges. Non-Indians directly can't invest into Indian stocks at this moment. So they use P notes. There's a lot of intermediary processes that you can use, but they are very obscure and expensive. So they require accreditation in some cases.
It is the KYC problem, right? You can't even buy funds or whatever.
Yeah, the same problem. So essentially, SEBI KYC does not. So the individual investors aren't allowed to invest directly because of some. I think this RBI FEMA.
What about the new Gift City? If there are funds that are created in Gift City, can then individuals invest there, or it's only for institutions?
Individuals can. The funds in Gift City are considered to be offshore. So they can receive the money there, but they will invest as a fund into the Indian stocks. So the underlying investors will not get directly voting rights into the companies.
All right, I guess that sums it up. One other interesting question that we have coming up is regarding the RBI policy and the interest rates in the current environment. So recently, the inflation numbers were published, and wholesale inflation numbers, CPI numbers, were pretty high, and it caused some panic amongst the people. The US Fed has shrugged off inflation worries, calling it transitory. But is it prudent for RBI to do the same as well, since we have seen that they have been suppressing the 10-year Indian bond yield a lot? Is it a right strategy in your opinion, or what else could be done?
Yeah, so in general, my feeling on inflation is this. India is actually going to see a substantial reduction in inflation in the coming years. A lot of our inflation is related to food. 50% of our inflation is food, and there were some prices of food that did go up this month, this last month, that was in May. But I think that will have cooled down or will cool down substantially in the coming months. Remember that May's inflation is not a real number, in the sense last May, the numbers that of inflation that were there were derived. There was no data collection for April and May 2020. Numbers were derived from some proxies. Those proxies aren't accurate. So it's only from June 2020 that we actually have actual recorded numbers. So there's a recording process for CPI, which Consumer Price Index, which happens on a monthly basis. People submit data, that data is collated, brought together, and indexes are determined. Because of the lockdowns in April and May last year, April and May data was not collected, and they created proxies. So they created the proxies in July or something, and gave us a backcasted data source for April and May. So what data as inflation you see for April and May is a little bit suspect. Even the 6% plus number is a little bit suspect. But one thing was true, of course, last May, I think, was when, or last April and, or May, I think, was when if you remember, the crude prices actually went negative in the futures, and they had fallen substantially. So there's a big jump from them to now. But that jump will get corrected in the next 2 or 3 months. So if crude remains at the 70, 72 level, even then we should see inflation reduce substantially. And there's actually not that much of a cause for the hike in crude prices, other than the fact that shipping worldwide has been impacted quite negatively by the whole crisis in the last year. So some of this is definitely transitory. For instance, shipping rates are 10x for anything, for dry stuff, dry bulk. So one of the reasons for that is because containers are in bad shape. The containerization of the world economy has meant that a lot of containers have been made, and these containers just ship from port to port. So what happens is, if you take containers from one port and go to the next port, there you dump your containers, and then they don't get unloaded. The containers don't get unloaded. They just take whatever empty containers are in that port, load them on, and go on to the next port. So the idea is to rotate containers like this, and this has worked very well for a long time. With certain ports in the world not acting fast enough, having blocked or having lockdown due to COVID and so on, there's a buildup of containers in certain ports. There's not enough empty containers to go around. Shipping costs and container costs have gone up quite substantially. This is most likely temporary. It will readjust in the next 6 months to a year. So in that context, I think a lot of inflation, which the Fed is talking about, which is primarily goods-based inflation, will come down. For India, it's mostly food and fuel. I think both of those will come down as well. I don't think the RBI is right to defend something at 6% so blatantly, because 6% is not really the index. So if you think of the 10-year, it is at 6%, but the 9-year is at 6.2, and the 11-year or 12-year is at 6.2, 6.3. So there's a big difference. There's a blip in the curve there. And RBI is trying to protect it by saying we're not going to let interest rates rise, but interest rates are high for anything else. So even the 50 bond, which is a 30-year bond from now, recently went to 7% plus. So I think the problem here is of extremely high supply expectations by the government printing requiring a lot more bonds. Therefore, people are saying, listen, I don't want to own it at this price. But inflation in general is not going to be a problem going forward. You're going to see the massive change in logistics when the lockdowns unwind. India has actually leapfrogged about 4x in logistics in the last 12 months, simply because it was a necessity, not some planned thing. So even in small towns now, massive improvement in logistics. Your ability to get goods there has increased dramatically, and a good portion of price increases or price changes were related to how costly it was to get items to smaller towns and just move them around. So I think we're going to see much lower inflation. Talking 2023, 24, intermittently you might see some spikes.
So the current inflation is mainly due to the supply chain crunches, and it will be transitory, as the Fed says. Still, people are quite worried about it, and just saying that it will go away doesn't calm the people as much as it should. And people have this doubt that how can one be prepared for inflation if it actually doesn't start lowering down, say in 2023 and onwards. If it sticks to those high levels, how can one be prepared and invest accordingly?
All right. So here's the thing. Okay, look at your inflation. My expenses have gone down quite substantially in the last 1 year. Just comparing it to, let's say, year, maybe last March or something like that. And the reason is I can't travel, I can't go to restaurants, I order stuff for whatever we need, but that's pretty much all. Even our food expenses have come down quite substantially. I haven't seen, I've been calculating my expenses since 2005 roughly. Average inflation is sub 5% for me even from then. And I have had 2 kids along the way, and so I'm not counting the school expenses, but those are more related to choices of school. But even if you count the school fee hikes that we have seen in the last few years and so on, my average inflation comes to around 5% or less. Recent years, it's even been lesser. So I think we'll have to calculate that for you. For instance, mangoes. We were looking at this and saying from 2005 to now, the average mango price per kg, it's a descending price, right? So it starts off in March at some 200, 300 rupees a kg and comes down to 80, 70 rupees a kg. It's the same, regardless of which year. 15 years, it has been the same on 200, 300 to start with, and 80, 70 rupees a kg to end with since then. So some elements have got substantially cheaper. When I was, when me and my wife were going, before we got married, when we were going around, my average cell phone bill was 10,000 rupees a month. Today, I have 4 SIMs between us. And for those 4 SIMs added together, I paid 10,000 rupees a year for 4 SIMs. And that time I was paying 10,000 rupees per month for one phone. That's just mine. My wife used to have a similar bill on her side. Now, so some things have, fallen quite substantially in price. And my usage pattern is very different from the general economy. I don't spend 50% of my expenses on food. I spend maybe 5%, or another 5% on petrol and diesel. Now even that's gone, right? So because even though the price of diesel petrol has gone up, I am not going anywhere on weekends, and even if I went to office 4 days a week, it would be substantially lower than I was spending earlier. So my personal inflation from a usage perspective and spending perspective is not quite that much. If you look at it the same way, I think we should just probably see that the people in this, the English-speaking, relatively rich 1% of population kind of demographic is going to not see the same kind of inflation as the rest of the economy. I think our inflation will come down. Medical inflation may go up, but even that is unlikely to go up very dramatically. COVID has shown how much it can go. But I think over time, that's also a question of supply and demand. So I think prices over there will also, meaningfully correct. Just my view. I mean, I may be totally off on this, but I don't think we're seeing hyperinflation in India anytime soon.
So even though some prices are rising up that we can see in everyday life, the overall impact on a person isn't as high as the numbers suggest. People just blankly see their wholesale inflation and everything. Still, even if people want to invest, and people are also used to high fixed deposit rates, do we see high fixed deposit rates coming back for people, as FD is one of the most popular investment vehicles?
Okay, let me answer this question in a slightly more macro-ish way. Today I was talking to somebody, and he was telling me, a good friend, and he was telling me, Deepak, we're selling our economy. I mean, we're selling all of our companies to these, to the foreign companies who are coming in, all these Abu Dhabi investment fund and somebody else and this and that, and all they're coming and bidding for our for our companies, and eventually all of this will go to foreign hands. And at a macro level, that is a problem, because you want, so you think about it in some in another way. The reason why people in India they haven't invested in risky assets, like even our own stocks, other than the promoters. If you take out the promoter holding, 50% of our free float, 43 to 50% of our free float, is owned by foreign institutional investors. We don't like to invest in risky stuff simply because we get great fixed deposit rates. And that creates a culture of not investing in the economy as a whole. Fixed deposit rates make you satisfied, and that's how people are, because they feel very comforted by that. But this is precisely how economies have to be spurred up going forward, is people have to be able to take risks, invest in risky things that can perhaps grow and become big. Whether it's a startup at one end, whether it's a business at the other end, whether it is more risky debt at the third end, is not is all of it will contribute to growing the economy. So if you're a person who's looking to take a loan today, forget 6%. You're not getting a loan even at 8 or 9%, other than the housing loan. You will get loans even if you put 200% collateral. You will not get a loan for less than 8.5%. And if you don't have collateral, the lowest you can probably get a loan for is 14%. Now, overnight repo rates of 4%. You can get a loan at 14. There's a 10% spread between the two. This is massive, right? So what will happen, according to me, is that I don't think FD rates will come down. If the RBI raises rates, it will go and hurt the economy even more. The economy is already battered. It makes no sense to raise rates. Today, you should be able to access credit cheaper, not more expensive. And a lot of small businesses have been wiped out in this crisis. They're going to have to come back. It'll have to need a lot of credit given from either the banks or from SIDBI or from a bunch of players in this system. I think at best we should expect that any increase in rates will be transient. Over the longer term, as India gets more efficient and all that stuff, we're likely to see even more reducing rates. There may be some period in the middle where rates go up. But over time, our rates are phenomenal, right? So today you can get 7% in an FD from some banks, which is quite remarkable. Even with inflation of 5.5-6%, you're able to get more than inflation, substantially more than inflation in fixed deposits. That's also an anomaly. So I think fixed deposit rates, we shouldn't expect them to go up. The way the RBI is looking at the economy and the way the West has managed their financial crisis is by overloading banks with money, to the point where banks have reduced their deposit rates because they don't need money. So if that's the case, you're not going to see higher fixed deposit rates. You're going to have to take risk, whether it is equity, whether it is more expensive debt, whether it's investing in startups, to be able to get super normal returns. You will not get the 8-9% from those FDs as easily as you did earlier.
All right, I guess that.
Hey, sorry, am I still here?
Yeah, I guess that answers the question. The rates aren't going to go up because it will hurt the economy a lot. So it's time to start investing in riskier assets, I guess. That's how the world works now.
Yep. Just a word of caution, this doesn't mean throw everything out the window. And if your inflation is 4% or 3%, then getting 5% is fine. Just saying. Hey, I think I lost you. Am I still here?
Yeah, you're here, man.
Yeah.
Okay.
Yeah, you are. Just Deepak had some issue. Anyway, can you repeat the question, please, Helen?
I can't hear Helen. If
Sorry, is Helen supposed to speak? Yeah, we can't hear him.
Yeah.
I guess.
I can take over.
Yeah.
Can you hear me, Deepak?
Yes, Mas. Yes. Thanks.
All right. Yeah. So we'll come back to that question when help comes. So we have next up G Kate asking you whether you would recommend your clients to invest in companies whose products you don't agree with. So this is not necessarily an ethical question. Specifically, they give the example of LIC IPO coming up and how ULIPs are generally frowned upon in investment circles, right? Would something like this be a deal breaker for you, or would you still consider it?
Okay, this is, I think there are two parts of this question. Perhaps Anoop can take the momentum part, because sometimes there's a difference in this, this thing. So let me give you my view from a perspective. We talked about ITC earlier. Sorry.
Yeah, go ahead.
So we talked about ITC earlier, and I don't think a lot of people who are buying ITC want people to die of lung cancer. So if you ask if anybody who owns ITC agrees with people smoking, I don't think the answer would be yes. So sometimes a business is different from what your investment philosophies. You can invest in sin. You may not like gambling, but you may still buy a casino. You may not like alcohol, but you might still buy a United Spirits. This is, it's not really relevant to the overall investment thing, because the company is built out of the management, the product, the market, and if you, I mean, there are people who say I will not invest in a company that sells non-veg because I don't agree with it. I think it's different for different people. I think investing is a very different philosophy. You don't really care. It's an old story in Indian mythological literature, and apparently this man goes. This guy is a guy who's been praying to the gods for ages, and then he hears a voice saying, "Go here," and he goes here, and he meets. He meets a woman there, and she's supposed to be a wise woman, and she says, "You have to meet this person. He's a really wise man." That wise man is a butcher, and he's like, "How can a wise man, a religious man, be a butcher? I mean, it's just not possible," and all that. And there was interesting part. I don't know it ad hoc, but the theme was that you do what you do to earn a living. But that, even if you sometimes don't agree with it, and just because you kill a butcher, an animal, is not different from killing a fly or an ant, and you do that all the time. So the justification for this can be often meaningless. So I think the same here. Investing is a different concept. Investing, no matter which company you invest in, there will always be some sin in it, and there will be something it does that you don't agree with. So if you keep it separate, most likely you'll end up investing only in fixed deposits, and even that of banks, which do things which you don't like. So eventually you'll not be able to do anything if you go deep enough into that rabbit hole. So that's my thought. But I'll let Anoop take the momentum part of it.
Sure.
Anoop, quick question before you start. Would you buy HDFC stock while you still have a home loan from HDFC?
That's you stole my thunder, Vashisht. Basically, I think if you look around for products which you don't agree with, like Deepak said, you'll end up not being able to invest in pretty much anything. So, and HDFC is a great example where they probably got the shittiest online experience, customer experience that any bank can give, and here they are as the biggest private bank by market cap in the country. And maybe get a little bit of those earnings in your favor. So if LIC is selling products which which many of us won't find as acceptable investment products, it's a fact. But as long as they're doing it and making money off it, you might want to reconsider, boycotting them as investors, because you might anyway be customers to their products, right? So you might as well, you're probably better off being investors than customers to their products. And then coming to the momentum angle of things, I guess Deepak's point when he said momentum was you've got to think of companies as black boxes, or almost as anonymized symbols. And as long as their prices and volumes are moving in the right direction, then they make for good investments, and there's no harm in actually getting in, and as long as you know when is it that you're going to get out. So trying to maybe conflate what you think about a product or a service with an investment approach might not be the best way to go, in a nutshell.
That's a very helpful way to think about it, I feel. And interesting tangent from Deepak as well. So we have another question from Jersos, who asks, from a beginner's point of view, how should an individual investor interested in learning about stock picking start the journey? Now, Jersos has mentioned that they're looking for something that doesn't require diving deep into technical complications. Do you guys have a starting point for them? Or do you feel diving deep is the only way to do so?
There is a starting point, obviously. I mean, I think, okay, if you're looking to invest versus, is the question about looking to invest versus looking to learn?
Sorry, could you repeat that?
I meant, would was the question more related to how do I invest as a beginner, or do I
No,
do I need to go deep?
he's specifically asking for individualing in investing in individual stocks. He wants to do the stock picking part. Yes.
Okay, so this is more complicated because the investing in general would be, I would suggest, an index approach or a mutual fund approach, simply because you leave the complexity to someone else while you learn. But learning is a lifelong process, so you're going to make mistakes. So I think the way to do this is first you start off with money that you can afford to lose, and do the things the way that you'll have to go through some of these cycles on a person. It's like, somebody tells you, listen, after you've had a baby, you're not going to be able to sleep for a while. I had no idea what that meant until after I had a baby. So people will tell you these things, and I'd be like, yeah, you're telling me this, I understand, but it's not going to feel the same way. So I can tell you that, listen, you've got to learn about stock fundamentals, and there will be some fundamentals which are visible, some fundamentals which you're going to have to go back in and analyze and see the underlying detail and understand it from not just the perspective of the numbers the company throws at you, but the numbers in context of the industry it is in. So if someone has a wage bill that is 60% of their expenses, whereas the average industry wage bill, which is 10% of the expenses, where in the industry they're in, it's average 60%. You know that something's off over there. You can't have a company who's, so it happened recently. There was a company called Ease My Trip, and they said they were profitable. But when you look at the books, you find out a lot of their profits came from some coal mining, something in the last few years, which of course they admitted that was the case, but it's not the business that they can continue to earn from. So now as a new business, you're investing in something else. So I think I could tell you that you look at all of these factors, fundamentals and the technicals, and learn through them stage by stage to go through, because investing in a company, you're not going to invest in one, you're going to have to invest in many. So let's say you invest in 15 companies, you're going to have to analyze at least 75, 80 companies. For that, you're going to need some kind of a framework to analyze them all. So you've got to find the framework that works for you. So do I like growth? Do I like value? Do I like momentum? Do I like high quality? And these are all different factors. Value being a stock that is substantially under valued compared to its future valuation. Now, the valuation concept itself is big, but I won't go into that. I'll say that you could value a company and say its value, it's worth 100 rupees a share, but currently the market's trading it at 50, so I'm going to buy it. Growth is whatever the company is worth right now, it's going to grow so fast that it's going to be worth a lot more in the future. So your analysis is primarily around growth. Momentum is the stock price is moving, and therefore it's likely to go up. Quality is simply the company has almost no competition like Nestle and baby food or Asian Paints. I mean, Asian Paints is number one in the paint market. There is good competition, but it's one of the most efficient players there, and so on. So you might say, I'll pay more for quality, but simply because they will survive and they've survived for the last 30, 40 years, they will continue. So you find at some point when the market crashes, you find more comfort in a value than in a growth stock. And that discovery process is who you are. So it's going to take you at least one cycle to figure out what I call the uncle point is, which is the point at which you have to ask your uncle for help. That point can be when you lose 50% of your money. Sometimes can you lose 30% of your money. And a lot of us people who are at least coming from a tech background, this is me, we don't like to lose when we invest, right? So I mean, we've not lost most of our lives. We've got 75, 80% in our whatever, and you don't like to get questions wrong. So you say, I want to get all the questions right. In investing, it's hardly a 50-50 game. You're going to have to understand that you're going to lose roughly half the times that you invest in. So that is heartbreaking for a starting investor, especially when you do so much work analyzing a stock. How can you be wrong? Is really so you go through this heartbreak to understand. So that's why I say play money first and then build it up to serious money if you're planning to go down that rabbit hole.
Follow-up question from my side on this of analysis, risk management, and valuation. What do you think is most important for a retail investors to look at while in stock pick while doing the stock picking process?
Um, uh, it's very straightforward to me. It's not sexy, but it's risk management. When I say risk management, it's like how much money do you put in a stock? This is position management. So people like to focus on the entries and exits, which is when did I get in, when did I get out? Hardly see a lot of us earn money on a monthly basis. We have to invest. We have more to invest on a monthly basis. Our net worth is growing in a way just because of this. Uh, how much percentage of that net worth is invested in the stocks that we like versus the stocks that aren't doing so well in comparison with when we started off analyzing? Do we have a position management system that says, I won't let this position become more than 10, 20% of the portfolio? At the same time, I won't let it be too small. So less than 1% of my portfolio is not worth it. So I know people whose net worths, apart from their primary residence, is say 50 lakhs, and they have 5,000 rupees in a stock, and that doubles. Doubling does not give is great to take home, but effectively you've screwed up in the whole risk management, position management, money management part of the setup, which is you've done the right things, you just don't have enough in the position. At the same time, you have too big a position. Maybe you have something that you bought a long time ago that's become 10-15% of your portfolio, and you let it go down by half. So either you didn't take because now you lost a significant percentage in just one position. So I think risk management is the most important thing to learn, but it's also the least important, least sexy thing in the investment hypothesis, because everybody wants to be a selector of stocks and a timer. I bought it at this time. They don't really want to make money out of it. So maybe that's what you get, if that's what drives you is to find great stocks. But I think to make money, you have to actually work hard on positioning.
I think that's more than fair. I completely agree with you. We have a question that is very related to this, and this comes from the subreddit thread. Better Swim asks, "What are some quick indications in a company that you look for that help you decide whether it is worth investigating further?" So basically, they're asking what your screening methods look like.
Okay. In general, the feeling that there will be one factor, I don't think it true. There are people who invest only on one factor, and for them there's a very clear criteria of things. I look at basically there is a lot of good in the world, and there's a lot of good that will be made visible to you. You have to find the bad and agree with it. In the sense, agree that this is a risk, and so if the red flags aren't as bad, but the company is great. So when I say a company is great, I mean look at a company. Like I'll give you an example. If you look at this is not a advice or recommendation or anything like that.
Yeah.
Okay, let me not even do an Indian stock, so just avoid the whole thing. So let's look at would you buy an Apple today? Given that the fact that it's run up, it's the highest market cap in the world. So the answer to that comes from what does Apple do and whether that is scalable in the future. And at a base level, do I agree with what the company, with the company's growth prospects? The answer, I think,
Can you
there
hear me?
is yes.
Ritul, just hold on. We'll introduce you in a bit. Deepak is asking a question right now. Answering a question.
Sure. Oh, okay. Okay. So let me just I'll tell you what name this. I forget where I was.
Yeah, sorry about that.
Sorry, I think I lost my thread there. We were on how to
We're
select
on
the stock.
the Apple exam. Yeah.
So the Apple example here is that I like the company. I might so I maybe I don't use Apple products. I mean, just this is me being very Microsofty on the and Androidy on the whole platform. But I do respect the fact that they have fanatical product loyalists who will stand in queue and pay $1,000 for a monitor stand. I mean, that stuff you pay for as an investor. I might not agree with buying a monitor stand at $1,000, but if they have enough customers who are crazy enough to do it, I mean, I'll buy their stock. But um, at this valuation is the next question, right? So saying, do I like this company? Do I like the financials? Do I like everything else? I think I like pretty much everything about it. There are some risks. The one is, of course, at a product level, they could lose favor. We've seen that once before. Although they were very popular in the early 80s, they lost their mojo sometime and then came back with Steve Jobs. So what do they lose to their mojo now? What happens next is, that's a risk that you have. The second part of the risk part of the process is simply that they get hit by a lot of taxes and fines by the US government uh, 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 because the US decides to tax their massive cash hoard, which is currently located offshore. Apple actually takes debt in the US, has a lot of cash offshore, and it uses the debt to pay dividends and do buybacks and all that stuff. So it's a little complicated as a company that way financially. So if you look at that, you see there are certain risks over there. Other risks of price. The price could be extremely high, and if I looked at Apple's price today in comparison with a lot of Indian companies that do not have the same kind of stranglehold on their customers that Apple does, I think that we're overpaying for Indian companies. In comparison, I'd rather pay for an Apple. Um, so, if you think about it, the metrics that go around selecting a company will be around most of these factors. I like, for instance, growth. If I don't see growth in a company, I'm not very likely to buy it for the long term. I might see a short term opportunity where there may be a bridge in an arbitrage or something like that. But the long term opportunity simply doesn't excite me. Similarly, a lot of commodity plays don't excite me per se. Steel companies, they will see momentum once in a few years and then they will go back and fizzle out. So you should invest in those companies from a momentum perspective, but not from a long term perspective, because they this is not the right time to playing cyclicals is a different story altogether. Whereas companies that are in the infotech space, they seem to have live more charmed lives. So those are stocks that you should build a position in on at any time, and there may be points at which there may be opportunities in one stock versus the other, simply because valuation differences and growth potential differences. Some IT companies are very well focused on electric vehicles, for instance, where the market is reasonably huge going forward. So at some point they will trigger and move into the next orbit. So it's more a quantum leap than a sudden, than a gradual move. So the analysis process of looking at which companies are good is it will encompass all of them. Remember, most importantly, I don't care about being 100% right. I don't need to have all my ducks in a row before I I go in. So I'm happy to take small positions and let the position build based on confidence over a longer term. And I don't mind having a lot of positions in the portfolio. I don't mind having 30, 35, 40 stocks. Simply because anyways, even if you want 15 stocks, you're going to have a portfolio of at least 7,500 to analyze. So you're going to need to track that many companies no matter what. So um, I think over time, you can build into portfolios that will anyway be 15 companies will always surface to the top, regardless of when you start. In 10 years, you'll have only about 10, 15 companies giving you 20% of your returns. So your main thing is to not miss too many opportunities that have gone by simply because you were too squeamish to get in a because every position needed to be 5%. I don't mind a 1.5%, 2% position also, and then slowly scaling it up. So given that my filters are relatively easy, but main thing I look for is red flags, corporate governance, issues with cash flow, issues with too much debt, issues with promoter past histories. Those are things that actually make me more fearful. That's what I pay more attention to when I look at stocks to buy.
That's very insightful, Deepak. I'm sure that will help a lot of us. So next up, we have a question from Ritul. Ritul is on the stage here. Go ahead, Ritul.
Hey Deepak, so myself Ritul, my question was relatively straightforward in the regards that Kenneth French, the noted economist, said that most of the realized return that an investor get comes
Either I went off or he went off.
He went off. It's okay. Helm, can you take over and ask a question while Ritul sorts his microphone issues? Helm, we can't hear you. Bagheera, can you take over? It's okay. I think everyone is having some issues. I'll take up the next question. Just so I know, can you guys hear him? No. Right?
No.
No.
I heard Ritul for a second.
Ritul's
Yeah,
back.
Ritul. Go ahead, Ritul.
Yes, unless he said that.
So the most of the return that an investor gets comes from the unexpected part rather than the expected part. And he gave the example that if people knew on September of 2010 that the FANG stocks are going to give a CAGR of 34.25%, it wouldn't have had happened. So I wanted your point of view on that, since most of the people currently are on Nasdaq 100, as it has given amazing 17 around from 2005 till now has given 17%. Other than that, it has given more than 25%. So most of people are currently using Nasdaq 100 as their primary motive for growth stocks. So do you think that this amazing performance will continue, because already people have an expectation of a growth rate? So can they deliver on that expectation, or that the unexpected path, that is the lower growth of the return, will prevail?
Okay, I will probably take one part of this question. So let's hear this let's look at this from a perspective of saying, if the stocks go up, will they keep going up in a way? Simply because people look at the past and say they've gone up, so they should go up more. And if you look at this question in its peculiarity, there are two things that I'll say. First, look at indexes. Indexes contain the largest companies in the world, and they're weighted by the market capitalization, right? So stocks that went up, the indexes have beaten a lot of mutual funds who are active managers who can find good stocks and all that stuff. Indexes are consisted of stocks mostly that have already gone up, so they've already reached new peaks, right? So Reliance and TCS and HDFC Bank and all that stuff. So why would you invest more in them? Because maybe the past has been great, but the future may not be. But it's almost never the case, or very, very, very rarely the case, that a stock that has done so well in the last few years will suddenly stop working. It happens once in a while, but on the whole, the momentum continues. And sometimes great moves make stocks better fundamentally also. And let me there's a reflexivity here. Reflexive funda is that if A impacts B, then B also impacts C. So if A is the stock price is going up because of the fundamentals, but because the stock price is going up, the fundamentals actually improve. And I'll tell you how. If you look at GameStop in the US, GameStop is a company with some debt, perhaps, and they were struggling as a company because their shops weren't open. They didn't have an online strategy and so on. The Reddit, Wall Street Bits Reddit crowd actually went in and said, listen, there are people short this stock, let's take them out because they ruin American economy or whatever. And then they went in and bought GameStop options in a big way. GameStop price goes up 5x, 10x, whatever it was. Then GameStop's issues more stock at this 150 or whatever, some crazy number level. It is able to raise a lot of money for a relatively small dilution. This makes the company fundamentally stronger because it's able to repay some of the debt and reduce the overall debt to equity issue, which is the reason why people shorted it in the first place, saying this company is going to go bankrupt because there's too much debt. So it's able to raise cash at very high valuations. It actually fundamentally becomes better, right? So sometimes, it's also the fact that when our stock price is going up, it actually becomes better just from perception. There was a reason when Indian IT companies listed when they did in the US. There was a very simple reason. If their stock price was visible to their customers in the US, that stock price would actually give them confidence that this is a growing company. And if that stock price kept going up, you got the feeling that this was a growing good company. And that's the kind of company you want as a supplier to you. So it's a reflexive element here. So I don't think that just because stock has performed in the last, or Nasdaq 100 has performed in the last 10 years, is a time to say it has done well the last 25 years, it will no longer do well. But given that, I think you should look at factors that will bring it down. There may be some. Steel has done well in the last 6 months. I don't think it's going to do well. It's a cyclical. It does well every so often, and that cycle lasts about maybe 12 months to 14 months. Once that 14 months is over, steel demand becomes lesser than supply because supply increases, and then prices come back. So this may apply to certain sectors or certain kinds of prices, but I don't think it applies in general. The second one is momentum. We've seen momentum work across different kinds of markets, but momentum is another factor which tells you that if something has been doing something so far, it's not a good thing to say it'll stop doing it right now.
Thank you,
I hope
Deepak.
that answers.
Yeah.
Anoop, I think you're probably better at this to take this. Anoop, can you still hear us?
Am I audible?
Yes, now you are.
Yep.
So, referring to your, Eugene Pharma, actually, obviously the person who came up with the efficient market hypothesis saying that you can't get alpha in the market because everything that can be known is known, which if you really think about at a realistic level is not really the case. Not all investors in the market have the same information at the same time. In fact, when momentum as a factor was researched, he then sort of revised his original opinion to say that momentum is the premier anomaly, to say that is the one thing that cannot be explained by historic data. And the fact that a consistent momentum can outperform consistently, and therefore it can't be explained by the efficient market hypothesis. So, and if you then drill down into momentum as a factor, it does not really look at market caps. It looks at price movement overall, and that price movement can happen across market cap, across sectors for a variety of reasons. So the the thing to consider is, does momentum, which is essentially what has gone up, will it keep going up as a factor? Has it been consistent across markets and asset classes? Yes. There's a few different research papers that have looked at actually over 100 years of data across asset classes and geographies, and found that yes, a portfolio of stocks that consistently buys assets that have been going up in price has outperformed the general market. And so it could be large caps today, it could be mid caps tomorrow, it could be small caps the day after, because different things come into flavor at different points in time. And as long as you have a consistent method of picking those assets based on how their prices are done, then you have a decent chance of outperforming the market over the long term. So um, as opposed to trying to guess what kind of, whether it's large caps or mid caps that will do well, I would say apply a consistent momentum strategy of looking at prices and with some volume filters, and you have a decent shot at beating the broader market.
Thanks a lot, Anoop. I'm pretty sure everyone's doubts regarding momentum and why those portfolios are outperforming have been resolved. Next up, we have uh, a member from the audience. Please welcome Anoop. I am pretty sure he's quite a well-known person. He runs a podcast called Paisa Vaisa, and I think a lot of Anupam, sorry, my bad. Yeah, and a lot of people from the audience must be knowing him as well. So, Anupam, can you please unmute yourself and ask the question? Anupam, yeah, are you there? Oh, I guess we'll take it up after in a little while. Then, until then, we can have one of the other questions submitted in the subreddit.
But just hold on 1 second. I think people still can't hear you. Just to confirm, just give me 1 second. Sorry for the intrusion. Can everyone hear me? Can someone confirm on the text channel?
Yes.
We can hear you.
Okay, so just let me ask a question. While the issues are resolved, I think Discord is having some issues right now. Okay.
Yeah.
Next up, we have another question from a member who uh, goes by the name Jwari, and they ask, how should retail investors go about investing in bonds?
Okay, let me take this. Bonds are a complex beast, right? So because it's like a traded fixed deposit in a way. So what I would say is here that you have multiple things that happen. So for instance, look at a bond. Your issue is of two things. First, can the company pay me back? So you have to have some kind of analysis behind it that says this company's financials are sound and they're able to pay back. And I'll give you an example of companies that are not able to pay back. Recently, DHFL, we had Videocon, we didn't have any bonds, but they didn't pay back the banks. There was ILNFS, which had bonds, luckily mostly not accessible by retail. But we do have retail level bonds payable by companies like National Highways Authority, Power Finance Corporation, and so on. These tend to be public sector institutions, and where you might feel that, okay, listen, if they don't pay back, there's going to be a big mayhem in the market. So, most likely the government's going to support them and they're going to be able to pay back. This is quasi government support in a way. So, your primary question is that of credit risk. Is this company going to pay back? The other part of credit risk, which we sometimes don't see very clearly, is does the promoter of this company want to pay back even if he doesn't? So there are companies, and we've seen them go through NCLT recently in the bankruptcy, where the promoters have never actually really wanted to pay back the money. They always wanted to restructure their loans. So borrow 100, restructure it saying, acha tum 20% hit le lo, take a 20% hit, we'll go to 80. I'll pay you back 80 and then go back and say, no, take another 20 rupees hit. They've done this for ages and ages. It's only now that a bankruptcy law has come, which has forced the banks to take them to bankruptcy court and then sell them. So if you buy into a company where the promoter cannot or will not pay back, that company can go into bankruptcy. It's a 3-year process for you to maybe even recover some part of your money. So DHFL's resolution will now result in about 30% payout to some of the fixed deposit holders and some of the bond holders of DHFL. It's been some 3 years since the last payment was made, 2 years or so. So you're likely going to have to wait to get back even a portion of your principal back. This is a concern. So when you don't understand the underlying business, don't buy it. Secondly, they'll say that the business is backed with collateral. Loans are backed with collateral. So they'll say some company there is this bond, it is backed with the collateral of gold. My question to this is, have you seen the gold? If you have not seen the gold, do you trust whoever has seen the gold to say that there is enough gold there at all times? So if you buy it now, there's gold. Next month, when I check back, there must still be gold. 3 months later, there must still be gold. Somebody needs to be constantly checking, because that happens a lot where people will stuff gold into a factory to show you there's gold. And then the minute the loan is done, the gold is gone, and whatever else can happen. So that's the second part. The collateral itself may not be visible to you, and there are some new bonds also going around where they're saying, listen, they are backed by auto loans, and in case the company cannot pay, it's an NBFC that lends to people who buy commercial vehicles. If if that company, that NBFC itself goes bust, the underlying loans itself will continue to be held by the bondholders, so they can recover from the vehicles or from the vehicle owners who will be continuing to pay. My question really there is, why would this company go bust unless the people it has lent to weren't paying it back? And if the company itself could not recover the loans from the underlying vehicles, that means they couldn't go seize the vehicles or whatever, for whatever reason, then what are the chances that you as an end bondholder will be able to force anybody to give their vehicle so that you can then try to sell it in some third party market and then recover your money? The chances of your being able to use the collateral is very weak. So you have to go with a lot of trust. Third part about this is the yield and the dynamics of the bond itself, which is sometimes the bond will say, and I've seen this, Yes Bank had 81 bonds. The bond actually said this: if the bank is in trouble and RBI feels that the bank has to be rescued, we will not pay you back any interest or any principal. This is a covenant risk. Bond has a structure, a covenant that says that in certain cases your returns will come down. This can be very, very dramatic for you. So if you don't understand what covenants are, of course, don't buy these bonds. But nobody will tell you. You'll have to actually read through the prospectus to understand what these covenants are. A lot of bank bonds are like this, and people are being sold these bonds without pricing them of the risk that they could be denied principal or interest or both at any time with the discretion of the bank plus RBI. The last part is, of course, liquidity. You will not be able to sell a bond that you buy at any time that you want, because there may not be anybody on the other side. I have bought bonds. I buy a lot of bonds personally. I find great deals. I don't mind the underlying risk, and I will take that risk. But I do understand at the same time, regardless of whether I've bought SBI bonds, which will probably not default, I buy with no covenants. That's also fantastic. But the point is, if the bond matures in 2023 and I want money now, chances are I may not find somebody to buy those bonds, because those bonds are not always liquid. When you find a company like SBI, you buy its shares. All its shares are the same. They're called pari passu. So they all are exactly the same kind of shares. You buy Reliance shares, they're exactly the same. There's some now slight differentiation. Reliance is a partially paid share and a fully paid share. But these differences are not meaningful. There are only two kinds. But SBI has maybe 200 different types of bonds. Some that mature later, some that mature recently, some have high interest rates, some have low interest rates, some have an 81 bond covenant, some that do not. So all of these bonds are different. So therefore, you will not find liquidity for all the bonds. You may like a certain kind of bond, but a lot of investors may like a different kind of bond altogether, and they will not buy your bond. So liquidity is this mega risk that you're taking. So when you're buying bonds, if you're buying it saying, listen, I'm getting this bond, I'll hold it for a year, but it's a 20-year bond, then you may not necessarily realize the return on this. It may be better to go to a mutual fund that buys bonds, because mutual funds will give you liquidity on an everyday basis, other than Franklin, which was a disaster. But this is the overall factors you're going to have to look at when you buy bonds. There are lots of other smaller things. I won't go into those, but I think broadly these are the risks that you should look at.
Thank you for answering that question, Deepak. Let me take up the next question. So we have this question from Jersos, who wants to know your opinion on smart beta indices. Is that something you would invest in along with vanilla indices?
Of course, we are a big fan of smart beta. I mean, we have a passive index that is effectively a smart beta index because it's a combination of indexes, India plus the US, that we look at as one group investment. Smart beta can take many forms, right? You can have beta based on factors, saying momentum is one factor, low volatility is another factor, and value is another factor. So you can do a combination of factors that gives you beta. Could change the weighting of the stocks inside. So there are people who invest in equal weighted indexes. There are times in which equal weighted indexes make sense. There are times in which they don't. And the philosophy of using one kind of smart beta index versus the other is just marginally that, where you're saying I will change, I will have the same quantitative based, algorithm based philosophy, but I will change change a little something. So it will be not human determined, but maybe 90-95% algorithm determined, with maybe some form of, when I say some form of, there will be some elements like saying let the volumes be greater than at least so much, and so on, which are liquidity factors. But you have smart beta indices now in all sorts of avatars. I think NSE itself has like 20 of them, different kinds of smart beta. In the US, you have a lot more. I think this is the future, because the universe of stocks that you want to select in has been determined by the indexes themselves. So much money has been flowing to indexes that they are pretty much where all the action is. It's not how you invest inside of those. And whether you call them smart beta or smart alpha, there's basically a different way to get the same kind of return with a slightly a slightly better on the upside, slightly less volatile on the downside kind of return. That would be the future. It's not very popular in India yet. I think we as a mutual fund, we have applied to become a mutual fund, so we do want to explore a lot of these kind of smart beta and behavioral factor based indexes as well.
NSE now has 10 plus factor indices, right?
Yes.
So I think they have momentum, low volatility, quality, and value. And they've all come up in the last couple of years or so. So my guess is it's something to look forward to, because the reason they're creating these indices is because mutual funds can then create index funds on top of them. So I'm sure you're going to see a lot more passive and funds coming up. We already have the QTI launching the Momentum 200, Nifty 200 Momentum 30 index fund, and ICICI already has so many factor-based ETFs. So I guess that's the way most of especially the new mutual funds, and since we applied, there are also many more who applied. We all believe most of them are going to go this route and launch passive or smart beta type indices.
That's very interesting to hear. Next question, I'll pass it over to Vashisht and Anoop and give Deepak a break. What's a typical like in CM office?
We're not there, so right now there's no typical day. We just started going back to office, some of us, last week as the lockdowns started lifting up here. From Monday to tomorrow on, we're much more relaxed here. So a lot of us can start coming back. A lot of them of us already half or vaccinated also. So That safe. Typical day, I don't know, man. It's we just the last 1.5 years just learned how to work remotely. Anoop will have more to say. Anoop has worked entirely remotely, and he only recently moved to Bangalore, and that too right before, like, couple of days before the lockdown hit us. Anoop, how was it working remotely, man?
No, so I think, like you said, right, there's no typical day. We're a bunch of folks who are curious about investing. So we are always on our company Slack channel discussing different topics, discussing, hey, this is happening, this is interesting. Let's write something about this, and then somebody goes deep into it and does some analysis and comes back and writes a piece. So it's really it's a mix of discussing various ideas around investing, potentially, oftentimes arguing and debating about them, and thinking about what makes sense to write about. Hey, is this, are enough people interested in this? Sometimes we write something and wonder, does anyone even really care? And that's sort of the biggest fear anyone doing any kind of research and publishing a piece has, I guess. So it's mainly about discussing ideas, be it on Slack or on video calls on what will make sense. Coming back, doing some research, coming back, getting it challenged. Um, Deepak at any time has 15 different ideas going on what we could be writing about, and then it's sort of my job to figure out, okay, out of these, which are the ones we can actually do based on the different folks on the team. So we have folks who are based in Bombay, obviously in Bangalore. One person on our team is based in Gujarat, and I think this model is going to probably just become the norm, where is never really going to be in one room at any given point in time, which is going to all work remotely, and it's going to work just as well and probably better off because people are not spending time commuting. And in the case of CapitalMind specifically, it's a bunch of folks who got a common interest around investing, and everyone's sort of good at different things. Some folks like to go deep into companies and understand what's happening with them and listen to conference calls and come back with some insight. Other folks like to do quantitative analysis. Some others look at the futures and options side of things. So all of it put together kind of gives us a in short at having a good understanding of what's happening, and that's what I think keeps us going at any given point in time.
Sounds exciting. So, how many people do you have in the CM team?
20 now.
20.
Yeah, 20.
Nice.
PMS and CapitalMind.
Yeah, so 20 people running essentially two businesses.
Right. So next up we have Sleepy, who has a question. Sleepy Jarvis, could you unmute your mic and ask your query? First up, give us a mic check if you can, please.
Can you guys hear me?
Your voice is a bit muffled.
Just a bit louder, please. A bit louder.
Am I audible now?
Yeah, perfect.
Loud and clear.
Yeah, so I have a couple of questions. The first is regarding is the 6-month time frame we have, to shuffle stocks in indexes and even smart beta indexes. So is it too long now, considering the technological improvements we have and the way how quickly data is moving around? So should it be much lower now, considering how fast information is traveling? That's the first question. The second one would be, what's your opinion on?
I think we should let them ask the first one and then ask the second.
Yeah.
Okay, sure.
I think one of the main reasons for the 6 months that you see with indices is, the indices, when Anoop was describing momentum, at an individual level, you can, of course, create these strategies, run it yourself, and you have a good shot at outperforming the market. But as you make it real as a fund, and you get more and more money into it, you get these constraints around you, and you have to work within those constraints, where it's liquidity and money coming in, money going out, and so on. That once you start going from, say, 10 crore to 200 crore, 1,000 crore to 10,000 crore, your universe of what you can trade in will start reducing substantially, right? So when these factors, and let's be real, the only company creating indices is Nifty indices. So as they create these, they are working with fund managers and asking them to fund managers must be coming to them, look, I expect to get 1,000, 2,000, 5,000 crores in this fund. Can your strategy take it? Right? So they start from that point onward, saying, look, I have to design something where that can support 1,000, 2,000, billion, $2 billion, $3 billion of assets under management. Right? So that's where a lot of these things coming. What happens with very frequent rebalancing is every fund that implements, say there's a Nifty releases a index, say a momentum index, which is rebalance every week, right? That's the model a lot of us do. Like Anoop's, the way he runs momentum is rebalance every week. So it might not mean a transaction every week, at least a review every week. So if that's how, say, NSE decided to publish an index, imagine a fund trying to replicate it. Every time it does a transaction, it will incur a transaction cost, right? Every time it does it, it will incur, some kind of deviation, tracking error. The more transactions you do, the more tracking error you introduce into the system, because you will have to buy and sell, and you might not get the best price, and so on. Or your purchase itself will move the price so much. So you will start, the tracking error will be easily be a few percentage points, so 1 or 2 or 3% even, in a very frequently rebalanced index, which is why you won't see, I don't think, I mean, it might not be true, but my opinion is you won't see indices being published that are very frequently rebalanced.
Okay. So I have another question. It's regarding what Deepak has said, that we have to take more risk in terms of, getting yield, since we are not going to have interest rate hikes. So I want to know about your opinion on products like Win12, which have these, MLD, market linked derivative products, especially ones that are, backed by gold loans, etc. Since, gold loans are typically issued only till 70-75% value. So is this the way that, the future debt fund, is that the way that we're supposed to look, instead of an ultra short, gilt funds or something?
Yeah, so the Win12 guys, I mean, they're known to us, so you have to kind of look at this from this is these are risky products. So they are like taking a lot of risk in their equity. I'll tell you what the risks are very straightforward. The Win12 guys are aware that there is certain gold underlying these loans, but they do not have any control over that. There is nobody certifying that value of that gold on a regular basis. There is also there's a certain amount of trust you have to have in the NBFC. The issue is if the NBFC goes bust, then the chances are that the trust itself was not there, not valid uh, in the longer term. So you might actually find that if the NBFC goes bust, that the gold is also not there. So the kind of risks that exist in this field. The second part of this is that you're getting 11%. Now, of course, the NBFC is not able to raise at 11% somewhere else. They're probably raising at 12. Win12 keeps about 1%, and you get these are relatively smaller loans, so 15 crores, 20 crores today. On a balance sheet which has about 800 crores, 900 crores of loans. So what is the point of defaulting on only a 10 crore loan, 20 crore loan? So it's unlikely that you're going to get hit with a selective default. But if these loans go bad, your recovery process can take a considerable amount of time, even if there is gold backing it, even if those gold is sold, gold prices remain constant. Gold, if gold, for instance, falls 25%, and by the way, it has fallen 25% from the peak. If it falls 25%, your 70% loan to value suddenly becomes 100% loan to value, right? So if the gold prices fall 25 to 30%, so you need to understand that this is the risk underlying these portfolios, and because of that, you're getting the 11% return, which is why you're going in. So I would suggest it to people who understand the risk, who can go in. But again, there it's a diversification thing, so you might not want to put all your money in these kind of things. You might put a little bit of money there, a little bit of money in something that's lower risk, and so on. So you can ladder your approaches and diversify. So don't get enamored by the words. There's a tax advantage in having a market-linked debenture today. That tax advantage may also go. The government, once it realizes that people are using this to meaningfully, pay lower taxes on what is a debt product, they will change the rules. So that may also change, but also underlying the the concept of the bond is also that there's a lot of risk. So yes, interesting. I think yes, the future as well, but we need a lot more. So for instance, I would prefer a dashboard that tells me if you're doing a group of loans, let's say 50 loans. I want a running dashboard every month that tells me how many of those loans are prepaid, how many of the loans are now 30 days past due, 60 days past due, 90 days past due, and if there is a replacement, which is what happens in these loans, where if somebody defaults, a company, that is the NBFC itself, replaces those loans with a performing loan up to a certain percentage. So I want to know if there are replacements that have happened, how many have happened, and how many, and what is the vintage of those loans. So this kind of a dashboard is important to provide the kind of transparency you need for retail to invest in such products. It's not there currently. So you're going in a little bit blind and a little bit based on trust. That's what I would say.
We should remember that there's no free lunch. Even in these such low interest rate environment, even if they're getting like 10, 11%, there is a large risk associated with them. And people here should be really careful with what they are investing in. All right, I think that would wrap up Sleepy Jarvis's question. All right, so we have a different segment coming up, very interesting one. It's related to the uh, unicorns and the hot tech IPOs. Let's say Zomato, Paytm, and the other unicorns that we are. One second, please. One second. One second. One second. Oh, all right. Yeah. Okay. So we were gonna have a quick time check after this question. It's been quite a long time since we have started. Anyway, coming back to the question, it's regarding the tech IPOs, Zomato, Paytm, and all the other unicorns. So we know that Zomato has filed a draft RHP, and Paytm is also next in the queue according to the current chatters. How do you see these IPOs of Paytm, Zomato, etc. shape up? Is it just to cash in on this crazy bull run and the liquidity that we are having? Or is it a new trend that would sustain with more Indian companies doing their IPOs in NSE or BSE? We have seen that these companies aren't exactly profitable yet, and these companies also have huge valuations. So, given that the American tech companies had huge phenomenal returns for the investors, is it a similar movement of India, or should people, have proceed with caution with these tech companies right now?
Well, proceed with caution is like a universal phenomenon, right? You can't say no, don't proceed with caution. If you're driving on the road or investing, you would have to. But here's the thing, okay? Amazon, I think, from its debut in 1999, it fell some 90% in 2000, something like that. And it has fallen consistently every year. It's seen a 30% fall every year or 2 years. And yet, it is like the second or third most valuable company in the world today. And that's because it's executed phenomenally over here. So whether it is a great tech company or not is not going to be known today. It's going to be known in the future. A lot of companies, when they came in, they did not have great financials. Amazon was a loss-making company. Um, Google was very early. Facebook was early. It was making losses. Twitter was early, making losses again. So just the fact that they're loss making may not necessarily mean they're unable to make profits in the future. I think a company like Zomato has a tremendous amount of advantage, especially after the Corona crisis, because they've built a logistics engine that is phenomenal, spread over multiple cities now, and tomorrow into the same platform of a logistics engine can feed in so many things, whether it is today it's restaurant delivery, tomorrow it can be a ton of other things, however they choose it to be. And they're going to need to reduce their dependence from restaurants because not So that's going to be just one part of their business. But from a scale perspective, this has a tremendous amount of scale. Eating out is no longer considered taboo or bad or anything like that. And people like to, and since you can now get home cooked meals on Zomato, which is also diversifying from a pure restaurant framework to a cloud kitchen and a home kitchen kind of framework. So these are things that are the future. So why would the future not list in India when the future of these companies mostly is in India? So that we can participate in their growth as well. So I think it's a good thing they're listing. I think Paytm has also got a great platform. They have not yet figured out how to become immensely profitable, but I don't worry about that as much as I worry about the fact they lose market share going forward. And the same thing with Zomato. But I think they should list. And I think these are good companies that, when Info Edge listed, I actually wrote a post. I was a little concerned about some stupid thing. And it was really stupid for me to be concerned about it, because what they represented was a vision into the startup of India. So Naukri itself owns some nearly 20% of Zomato. They at one point owned 50% of Zomato. So they have benefited from Zomato's growth itself. Naukri itself has gone up 5x, I think 4x or 5x in the last 1.5 years. From IPO, it's up about 15 times, 20 times maybe. In the last 18 months, it's probably up about 4x or 5x. This is quite a phenomenon, because if you think about it, why would you buy into a company that just owns a job portal and maybe some stakes in Policy Bazaar or Zomato? The underlying philosophy is that there's a lot of growth that's perhaps coming in ahead of us. And these are the companies that are looking to capture that growth. Look at the last 12 months. The companies that have done the best through this thing are not necessarily public. I would say it's GeoMart. GeoMart, by the way, is not public. Its parent Reliance is public. You could say it's
Deepak, I think you muted yourself.
Oh, I'm sorry.
Yeah, you were on GeoMart when
So there's GeoMart, and there is the Geo engine, the stuff that is just done in the last few months, where they've got investment from Facebook and Google and a bunch of other players. But the company that got that investment is actually not public. It's a subsidiary of the public Reliance company. So eventually that will also go public. So there's going to be a lot of this activity that will say that a lot of the money that went into private hands has to become public and allow more people to participate, and of course allow the early investors to exit as well. It's a lot of money in India. I mean, a hell of a lot. Yesterday's IPOs, I think 2 days ago, whichever IPOs closed, one of them at 1,000 crores. It got 1,10,000 crores worth of subscriptions. So I think that if I have the numbers right, it was that heavily oversubscribed. So you have a lot of money chasing IPOs, and you have a lot of money chasing companies that some of them are doing, absolutely no technology based work. They're selling like metal of all things. So it's good. I mean, there will be some technology in it, but nowhere close to the kind of technology that say Zomato has or Paytm has, which encompasses multiple things. So I think India lacks deep technological or technical based companies which are building great products for India. If you see the indices today, they're heavily Hindalco and Tata Steel and all these old economy, coal India kind of companies. Whereas the US indexes are full of new age, Apple, Microsoft, Amazon. We use Apple, Amazon, Microsoft products, and they're listed as they're one of the top companies in the US. So I think India will also move into those kind of companies. We don't know which one will make it, whether it's a Nazara Gaming or it's a Zomato or it's a Naukri or some. We don't know which ones will actually make the index, but I know for sure that some will. So I don't think we should write them off saying, oh no, it's just liquidity and money. It's liquidity and money that made Paytm and Zomato have this business in the first place. How will you run a business which makes crores and crores of losses every year unless someone was funding it? and someone was funding it because liquidity abroad is cheap and that money flows into these companies as investment. That's how they benefited. So today, if they list and Indian investors buy it, I think it's the same liquidity that's just in a different place. So I don't necessarily want to write them off, but yeah, I mean there will be some mad valuations. There will be a Boo.com. If nobody remembers Boo.com, it's probably because they were one of the biggest companies in the 2000 IPO. They were the first to break down, and among the first to break down. And I think they ran through $150 million, which of course today is pocket change, but $150 million in 3 months, and then went bankrupt. So they were the poster child of the 2000 .com bust. So I'm sure there'll be a lot of those as well. So not saying that against it, but I do think there will be great tech companies that are born out of this as well.
Thanks, Deepak. I'm sure everyone is keeping an eye out for those. Just a quick time check. Do we have more time to field some questions, or should we wrap it up?
We take two more and then wrap.
Yeah, sure. Sounds good. Bug, you have some questions?
Yeah, sure. So next up we have one question regarding portfolio management schemes and AIFs. So when do these investment vehicles make sense? Like while there are many resources regarding picking up mutual funds, there isn't much material regarding investments in PMS and AIF. And what should one look when they're researching for these, and what are the right questions that a person should ask before investing into these kind of funds? Is there any checklist that you would recommend?
Okay, I'll quickly take this because I think it's also relevant in today's world. It's typically for the slightly more well-heeled. I'm talking about people with 50 lakh rupees that have investable capital that would want to invest in a PMS. Now, why would they do it? There are many reasons why. So the most common reason is that they want aggressive returns. They believe that PMS managers who are allowed to charge a performance fee and a management fee. A mutual fund can only charge a management fee. Portfolio management service, a PMS, can charge both a management fee and a percentage of return. So I can actually say, give me 1% of your corpus every year and also give me 10% of the returns or 20% of the returns above, say, a hurdle rate of 7 or 8%, which is a risk-free kind of capital return. I can actually see that. Now, given this structure, people tend to think that PMSs are for the aggressive investor, where you will go really aggressive and do great returns. This is one kind, and there are a lot of PMSs that do this. And to evaluate them, you may have to get data from some of these companies like PMS Bazaar and a PMS. There's a bunch of such companies that give data on the PMS performances, which now have become more standardized by SEBI as well. So you'll be able to compare performance of different strategies that they own and so on.
Quick note, nobody vets these performances. They're all, take it at face value. It can be wrong, it can be right, it can be manipulated, you never know.
Yeah, it's actually one of those things like we were talking about gold-backed loans. Who's seen the gold? Here, who's actually vetted the...
Yeah, if PMS Bazaar or if PMS AIF, or there are two companies who do this, they basically send out a questionnaire to us and maybe all others as well, asking us to report our numbers for the month, which now SEBI has standardized and we report the standard number. But again, nobody vets it to a degree where, if you're making a 50 lakh investing decision, if you're basing it on performance numbers, please take it with a lot of salt.
Yeah, and it's best also to ask, because ask for a reference where you require it. But one part of this architecture is that it's a little bit more of comfort and trust on the fund management exercise. What happens is that stocks are bought in your name in a PMS. In an AIF, vehicle is created and the stocks are bought in the vehicle's name. So you don't own it, you just own some units in the AIF. PMS, you're actually owning the stock. So what happens is, let us say you're a senior management employee in a certain company that is public. Let's say it's TCS. So the PMS should not buy TCS, even though the PMS is making an independent decision on whether to buy it or not. You will be held responsible for having owned those stocks because they're in your name. Versus if you invest in a mutual fund that invests in TCS, you will not have the same problem. So these are other factors to also think about when you have a PMS. I think there's two other factors, and we kind of try to focus on that, right? A lot of people tend to not have time to be able to do their own investments, and they want a simpler, easier, more meaningful way to do it. So a PMS, which the kind that we build, is more like a personalized asset allocation service. It says you can allocate between debt and aggressive and passive kind of equity portfolios. And for that, we don't charge a performance fee, we only charge a management fee. So people like us, PMS like us, would be more based on asset allocation and personalization than we are on just aggressive stock picking. So that is another reason to choose a PMS, which says, okay, I'll get a more diversified portfolio. It's the glorified advisor, but the advisor that can take their own decisions on actually which stocks to pick, whereas you work on just overall asset allocation, saying how much to equity, how much to debt. We have India's equity and international equities through ETFs, but that's how we've kind of designed the PMS. So there's not, we were among the first to do that kind of PMS, but there are a lot of those. What kind of PMSs are purely on debt? Because debt is a very structured person to person world rather than trading on a screen. So their contacts and connections help a lot. So you might choose a debt fund manager to give as a PMS, where it is more aggressive but perhaps better managed debt as well. So the debt PMSs are a third kind of entity that you might go. So you're for most people who don't have that kind of money, there's no choice of a PMS. You have to go through a mutual fund. People who choose PMSs, you should be aware that they have certain limitations, but they also have certain advantages. They tend to be they can be far more aggressive. They can do far better job on asset allocation. Our own PMS run by Anoop, the Momentum PMS, has done substantially better than most mutual funds in the last 1 year. I think probably in the top 5% of mutual fund performances, and we kept an open performance layer. So all our tech is inbuilt. So data of our tech is exposed. So we have, as soon as we expose it through APIs, at least in an aggregated form. So we get real performance of our portfolios every day on a page that that Vashisht has put up. Anybody wants, they can ping us for the link, so we can see the performances on a daily basis, just like mutual funds do. So you need a PMS to actually be as transparent as a mutual fund. But mutual funds are required by law to be substantially more transparent. So you need to actually have a big
one area where we are PMS is even more transparent is try asking for an invoice for the management fees you've paid to a mutual fund. You will not get it. I mean, there's no way you'll find out exactly what were the fees that you were charged. Versus a PMS, you can actually see exactly how much we charged you as management fee and overall transaction costs, everything put together. NAV kind of calculation for all our funds. And to round off Deepak's thing on rule-based stuff and asset allocation, only 15% of our AUM right now is in active stock picking portfolio. Everything else is in either debt or rules-based portfolios or passive portfolios. On AIFs, we also asked about AIFs. I don't know, man. AIFs are like PMSs, but the only operational difference is the fund owns and the investor owns units. So the investor doesn't have to file advance taxes and transactions don't happen in their name. So that's the only difference. There is a big attraction towards long short AIFs because in theory, they're able to go short and they can do kind of beat the index like that. But in practice, almost every long short AIF underperforms the Nifty. Majorly because of the very high taxation that is applied on the FNO gains. So even if you make something on the short side, you'll be taxed at 44-45%, which kind of takes away most of those gains from you. And if you're always long short and in a trending market, you'll most likely be underperforming for a long time. So you can check it out in a PMS AIF world. They publish a report every month. Like if the numbers are accurate, almost every long short AIF has underperformed Nifty.
I guess if we are underperforming Nifty, then it doesn't really make much sense. And one should closely vet all the investments and ask a lot of questions from the AIF.
It's for very sophisticated investors, and that's the idea also, right? The minimum is 1 crore. So if you are somebody, say, investing 100 crores, you will take Nifty like returns, but you want, say, half or 1/3 drawdown of Nifty. So it depends on who that investor is, and it's a different kind of investors, but it's not for everyone.
Yeah, I guess so. They also, the large limit of 1 crores or 50 lakhs also restricts a lot of people from investing in it as well. Anyway, so we are coming to an end to this session, and I have a question. So Deepak has been a part of this Reddit community for a long while, and over the last few years, we have also seen a lot of CapitalMind team members join in. So what do you think about this community, and what we should be doing, and what are some shortfalls that we could work on at our at Reddit/Indian Investments?
No, I mean, I don't think it's really a shortfall at all. There's a lot of stuff happening there. There's a lot of questions, very interesting, things. And I think you guys have actually been working hard to kind of resolve and get answers to common questions in some kind of wiki format so that people can kind of access it as a book. There's a lot of group work that's happening. That's quite amazing. I don't know if you want to get into. I mean, the problem is sometimes it's the flavor of the day that surfaces on top. Some of the deeper discussions happen to go back down. So sometimes I feel that questions become repetitive because you can't find the answers right at the top few. So may not necessarily the questions kind of tend to get repeated. So that's a common problem in any community. We've seen that in a lot of communities. Overall, I would say pretty good going. I think it's a treasure trove of knowledge. A lot of people share and really deeply share. I do think that, however, some of the areas don't get a lot of coverage, like macro. I mean, I've sometimes gone in, but I felt, I should do more on that front, maybe help to give my views a little more detail and so on. But macro in general doesn't get covered quite as much. And also, a lot of work and asset allocation gets repetitive. So I don't know if, people want to build portfolios for themselves and they have bunch of questions around that, and that surfaces every couple of months, I think. But I've seen this happen in all communities. People will forget. The question will be slightly more nuanced. So you have a new fire discussion every 2 months, a new asset allocation discussion every 2 months. So I don't know if there's a way to solve it, but I think it's a very meaningful.
It's good though, because the answers change every few months or every few years at least. Fire discussions on we had a long fire discussion in our community yesterday or day before. The answers were very different from what we had from the same discussion 2 years back. So because the world has changed, so it's always interesting to see the how the same answers to the same questions evolve over time.
Yeah, thank you for those insights, Vashisht and Deepak. That's actually something we are working on right now as well, trying to build a wiki for the common queries that we get asked every day. Anyways, thank you for your insights. That's something we'll work on. Now we are coming to an end to this AMA. Just before that, do you have anything you want to share with us from your side before wrapping it up?
Nothing actually. Thanks so much. This has been brilliant. Sorry, was that for me?
Yeah,
for
I
either of you.
I said like anything you would like to share.
No, I think we'd love to hear your feedback. I'll visit the thread if this on and on the Discord channel as well. So tell us please how we can improve as well. And we do write a lot of writing. Some of it is premium, some of it is free. So there is anything that we should write or we should focus more on. Always happy to listen to that. I think also do check out capitalmind.in. We've got, that's just me saying it, but again, none of this is financial advice. So we'd like to keep the discussion more towards an education piece, but we do talk a lot at both our Twitter handles and on capitalmind.in about a lot of things happening in the markets, in IPOs and stocks and macro and bonds. So I'd love to hear, what we could do to improve or what we may not have covered, which people would love to hear. And thanks so much for organizing this. This was a brilliant AMA. We've a lot to take home, and I think I couldn't answer most of the questions, but I'll take a look at them, and when I can, I'll probably put in my feedback as well. Thanks so much for having us.
No, all the gratitude is on your side, Deepak. Thank you for taking the time to be with us today. We really appreciate the insights you have provided for us. And I'm sure we all are looking forward for what's to come from Capital Mind next, especially in the mutual fund space. Vashisht and Anoop, do you have somewhere people can reach out to you if they have questions for you?
So all three of us on Twitter. Sorry, Anoop, go ahead.
Yeah. So on Twitter handle at Calm Investor, happy to engage on any questions that are there.
Sounds good. I'll just be pasting your Twitter links in a bit. So wrapping it up, thanks to everyone in the audience for joining us on a weekend afternoon. Thank you once again, CM team, for joining us. This has been a pleasure.
Thanks guys. This was fun.
Yeah.
Thank you.